Welcome back to Investing Talk Podcast.
Today we're looking at Celestica.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. You know, for a company that has historically just been seen as this cyclical electronics manufacturer, the recent performance from Celestica has been, well, nothing short of transformative.
Transformative is a big word. When you look at those Q3 2025 results, what numbers really jumped out at you? What signaled that big shift?
Well, the Q3 performance was just dramatic. I mean, it exceeded expectations pretty much across the board. Revenue didn't just grow. It absolutely exploded past $3.19 billion.
Wow.
Delivering a massive 27.8% year-over-year growth rate. But, you know, the real story is what happened under that top line.
The profitability.
Exactly. Adjusted earnings per share, the EPS, was so strong it jumped 48% year over year.
Okay, hold on. 48% EPS growth on what? 28% revenue growth? That's some serious operating leverage.
It is this.
It means their costs are growing way slower than their sales. Every new dollar of revenue is just becoming more efficient profit. That's the margin expansion story that gets investors really excited.
Precisely. And that kind of efficiency, that's the sign of a business that's moving into higher value, higher margin products. They're getting away from that low value assembly work.
Right, but that's all looking in the rearview mirror. The market, you know, it trades on the future.
Yeah.
On management's credibility. Did they actually back up those big Q3 numbers with serious guidance?
They certainly did. Management raised their full year 2025 revenue guidance in a big way. They moved it up from around $11.5 billion to $12.2 billion.
That's not a small tweak. That signals they see this momentum just rolling right through Q4.
And they bumped the full year adjusted EPS target for 2025 up to $5.90.
Okay, those raises are strong. But the real investment thesis, the whole reason the stock has run so hard, it all hinges on the forecast for next year. What's the blockbuster number for 2026?
And this is really the crucial part of our analysis. The company is projecting a full year 2026 revenue of $16 billion.
$16 billion.
$16 billion.
Yeah.
And it's coupled with a non-GAAP adjusted EPS of $8.20.
Wow.
So let's just let that sink in. It implies a staggering 31% revenue growth and 39% earnings growth in 2026.
And that's off the already high 2025 base.
Exactly.
That is an incredibly aggressive forecast. I mean, the market rarely just believes an $8.20 EPS projection without huge skepticism. Are they setting the bar too high here?
Well, they're betting on structural demand. But before we get to the why, let's just look at how they've earned the right to make a claim that bold. It's their financial health.
Right, because explosive growth can sometimes hide a shaky foundation.
But not here. The foundation is rock solid. They've got strong liquidity, a current ratio of 1.5, so they can easily cover their short-term debts.
And the efficiency. How well are they turning those sales into actual profit? We need to see that margin story in the metrics.
It's absolutely there. Their operational efficiency is excellent. They're hitting EBIT margins of 7.9% and EBITDA margins of 9.2%.
For an electronics manufacturing services company, those are numbers you'd expect from a pure tech company.
You really would. But the most shocking figures I saw were about how they use their capital, the shareholder capital.
You have to be talking about the return metrics.
Oh, yeah. The capital allocation is just, it's incredible. Their return on investment, the ROI, is at an astonishing 62.9%.
63% ROI.
And their return on equity, ROE, is a super robust 20.7%.
Right.
I mean, a nearly 63% ROI in this sector is unheard of. It just signals that every single dollar they reinvest is generating wealth exponentially.
It completely changes the game for what we thought was possible in this industry.
It really does. And it justifies why analysts are scrambling to upgrade their models.
Okay, these numbers are incredible. Growth, efficiency, smart capital. But they don't happen in a vacuum, so we have to ask, what is the strategic fuel igniting this rocket? It can't just be general electronics work.
And you've hit on the core insight. The entire strategy rests on one single fact. Celestica has positioned itself as a critical infrastructure partner for the AI data center expansion.
So they're not just assembling parts.
No, they are building the highly specialized, really complex machinery that makes a modern AI compute cluster actually work.
Can you clarify that? I mean, what specific high-margin products are they making that justifies a nearly 8% EBIT margin?
It's all concentrated in specialized infrastructure.
Hmm.
They're deep into things like custom liquid cooling systems for these high-density AI racks.
Which is way more complex than just standard air cooling.
Much more complex, much higher value. And second, they're producing things like high-speed interconnect backplanes and specialized server chassis. These are bespoke, engineered products. They're critical to performance, and they're really hard for competitors to just copy.
So that's the competitive moat.
That's the moat.
They're locked into the most complex proprietary parts of the AI build-out. And this is all tracked in their CCS segment, right? The Communications and Component Services.
Exactly. The CCS segment is the engine here. It's showing all the strength from these high-margin areas that cater directly to the big cloud and AI players.
Which brings up visibility. If these are such complex projects, does that give management more certainty in their forecasts? I mean, how far out can they actually see the demand?
Management's commentary gives us incredible visibility. They've confirmed robust demand from major cloud customers. And here's the key part. They have visibility extending all the way into 2027.
2 years out.
All the way to 2027. Hearing that kind of 2-year visibility in tech, especially for infrastructure, it's like confirmation that this demand isn't just a wave. It's a sustained multi-year tsunami.
It completely de-risks that near-term forecast.
It does. And it lets them plan their capacity in a disciplined way.
And that certainty has to be why we're seeing all this uniform, positive commentary from the outside. What are the big firms like JP Morgan and Goldman Sachs saying?
Well, analyst sentiment has been strongly supportive because of that visibility. Firms like JP Morgan, Goldman Sachs, they're all specifically citing the company's AI infrastructure position.
The liquid cooling and all that.
Exactly. That's the reason they're upgrading their outlooks and price targets. The street is basically agreeing now that Celestica isn't a cyclical manufacturer anymore. It's a high-growth infrastructure play.
Okay, let's shift from the market's view to the internal one. Are the people actually running the company? Are they showing confidence in this $8.20 future? Any signals from management?
We have several really strong signals. And, these often speak louder than a press release. First, we saw a director doing open market share buys back in October.
Oh, that's interesting.
Yeah, a director bought 6,000 shares at an average price near $340.
So a director is putting their own money on the line, hundreds of thousands of dollars, near the stock's high. That's not just institutional confidence. That's personal conviction.
It's a huge signal. They're basically saying that even at these prices, the real value is much higher.
And are they backing it up with the company's capital, too?
They are. They initiated what's called a normal course issuer bid, or NCIB. It's basically an authorization for the company to repurchase up to 5% of its public float over the next year.
So the NCIB, that's management writing a massive check and saying, we believe our stock is fundamentally worth more than the market is giving us credit for.
It's the highest implicit bullish signal you can get from a company about its own valuation.
And the board is aligned, too.
Yeah, and we shouldn't overlook that. The directors were awarded share units back in September as part of their equity compensation. It just means their own financial interests are tightly linked to long-term shareholder returns.
So it encourages them to execute flawlessly on that 2026 forecast.
It does.
Okay. That covers fundamentals and insider sentiment. Let's look at the technicals. The chart has definitely been reflecting all this good news.
It's been a textbook technical breakout. I mean, the stock has shown that classic bullish pattern, higher lows and higher highs all year.
Right.
And after the Q3 earnings, the stock surged over 11.5%, which just confirmed the move above those old resistance levels. And you have to remember, it recovered from lows below 290 earlier in the year, so it's built a really solid base.
So what are the key levels people should be watching as we head into early 2026? Where is the support and resistance?
Well, we're seeing recent support clustering between 312 and 315. That seems to be the new floor. Intermediate resistance is sitting around 330 to 340.
And that lines up with some of the analyst targets.
It does. Our 3-month outlook really suggests a trading range between 310 and 365, but with the potential to test 380, maybe even 400 if Q4 results are strong.
Okay, that gives us the technical map. So let's pivot to the immediate future. What dates should listeners circle on their calendars? What are the big catalysts in the next 3 months?
There are 3 major ones to watch. First, late November 2025. That's when the NCIB implementation window starts, so we should see share buyback activity begin, which can support the price.
Okay, what's next?
Second, January 2026 is critical. That's when the institutional 13F filings are due.
And why do the 13Fs matter so much here?
Because these filings will show us if the world's biggest hedge funds and asset managers have started big new positions in Celestica after these explosive results. If you see the big money validating the story, that's a huge catalyst for inflows.
And the biggest one, the moment of truth.
The biggest event is, without a doubt, the late January 2026 earnings release for Q4. Given their track record of beating and raising, this is the ultimate inflection point.
And if they show they're on track for that 820 EPS number?
Then the stock could easily test those $380 to $400 resistance levels we talked about.
And we should probably touch on the speculative side, too. What are some of the rumors floating around that could drive momentum?
Well, there's ongoing M&A chatter. I mean, a company like Celestica with its critical AI expertise could be a really attractive target for a larger player. And second, there are rumors of potential major contract announcements with some blue-chip cloud customers in early 2026.
The kind of deal that locks in revenue for years.
Exactly.
Okay, this whole analysis has been overwhelmingly positive. Explosive growth, great margins, insider confidence. We have to provide a balanced view. What are the key risks that could derail this whole thing?
We absolutely have to. And the counterbalance has to start with valuation. At a premium price-to-earnings multiple of almost 47, the market is pricing in near-flawless execution.
A PE of 47. That leaves zero room for error. So what happens, mathematically, if they just stumble a little bit?
That creates a massive risk of what's called multiple compression. If the company were to miss those growth expectations even slightly, say they deliver $7 of EPS instead of $8.20 in 2026.
The market would punish them.
Immediately.
Yeah.
Investors would re-rate the stock. They'd bring that PE multiple down to maybe 30 or 35. And that slight earnings miss could mathematically trigger a 20 to 30% drop in the stock almost overnight.
That's the tightrope you walk with high-growth stocks.
It is.
What about the actual business risks? You mentioned their big customers, customer concentration.
That's risk number one. Their reliance on just a few large hyperscalers, while it's great for visibility right now, means any sudden cut in spending by those customers could cause huge revenue volatility.
It's like having a factory where two VIPs buy 80% of your stuff.
Exactly. If one of them gets a cold, your entire operation could collapse.
And just hitting those huge 2026 targets requires massive execution, right? Especially with these complex products.
That's the execution risk. Ramping up capacity for things like specialized liquid cooling. It requires a flawless supply chain, disciplined investment, perfect manufacturing. It is so hard to scale that fast without any mistakes.
And any small slip could trigger that multiple compression we just talked about.
Right. And finally, you can't ignore the industry itself. The AI tailwind is strong, but this is still a cyclical sector.
So a big IT spending downturn could still hurt them.
It could. A major unexpected recession could still pressure demand and margins across the entire sector, no matter how well Celestica is positioned within it. So, to sort of synthesize the whole investment thesis here, the bullish case really hinges on two things. First, the sustainability of AI infrastructure spending, and second, Celestica's ability to keep expanding its margins on those complex parts.
So investors have to watch the Q4 earnings like a hawk for any sign of a slowdown. Any weakness in demand or execution that might threaten that aggressive $8.20 forecast. If they keep delivering, the thesis holds. If they miss, you can expect that volatility because of the high valuation. That is the critical variable.
Don't forget to hit that subscribe button to catch our next analysis.